Warren Buffett is often quoted as saying, if you don't make money while you sleep, you will work until you die. What does this mean? Well, let's talk about it. Hello everybody and welcome to Dollars and Cents, helping you make sense of making dollars. When Warren Buffett, a billionaire investor and head of Berkshire Hathaway, said those words, he was referring to passive income. For those of you who do not know what that is, it is income that's earned passively. Crazy, I know. Passive income, in relation to investing, usually comes in the form of dividends, or sums of cash paid out to investors from companies that deem that cash unable to further grow their business. As I discussed in my last video, dividend growth investing is when you use those dividends to reinvest and buy more shares of companies. However, what if you wanted to live off of those dividends? Well, it's entirely possible. Let's say you wanted to make $1,000 in passive income every month. This is a fairly solid amount and a great goal to hit. Using my current portfolio as an example, our estimated income this year, assuming we don't add any more funds to the portfolio, is $46.80. This is with roughly $1,000 invested. So let's scale this up. We need $12,000 a year in dividends. After a little math magic, we find ourselves needing roughly $256,000 invested in total. Yeah, it's a lot of money that most people can't even imagine realistically having. However, through smart investing and over time, companies increasing the amount they pay in dividends, that $256,000 can seem a lot closer. Like I said, this is a long-term plan, and Rome wasn't built in a day. Let's talk about a specific dividend growth company that is one of my favorite companies to invest in, 3M. It's a company pretty much everyone's heard of, and if you haven't heard of them, you have almost certainly used one or more of their products. 3M makes everything from insulating products to medical equipment and those amazing adhesive things you use to hang paintings on your wall. 3M is also a publicly traded company, listed on the New York Stock Exchange, has been since 1946. They also pay a dividend, have been since 1916, and have been increasing it every year since 1960. Assuming in 2010 you bought about 120 shares at $83.37 per share, representing a $10,000 investment at the time, without adding to that at all and reinvesting those dividends, you would, in just 10 years, have over $31,500, own 157 shares, and have been paid over $5,000 in dividends over that time. Additionally, you would now receive over $230 in dividends every quarter that you can choose to reinvest or to just use as regular income. This represents the power of dividend growth investing. It's investing in companies like 3M and others that we build that stream of passive income that we can live off of in the future. Thinking about it, the $256,000 needed for that $1,000 in passive income doesn't sound so far off, does it? All of this is why I found dividend growth investing so interesting when I first started out, as opposed to regular growth investing. I am risk averse, and I like stability when it comes to my hard-earned dollars. Dividend growth investing is far more stable, as we as investors typically like buying boring companies. No, not that boring company. I mean boring companies. Companies that are in the background, silently working, like the underpaid stocker at your local grocery store. Companies you've never heard of but have been in business for years, could be decades or more. These are the companies I enjoy finding and investing in because they have proven themselves stable over years of operation. Dividend growth investing is all around the most stable form of investing that I know of because of these types of companies. I contrast them to the popular companies, Tesla, Virgin Galactic, and Zoom, stocks that are incredibly overvalued and can present an incredible loss if they cannot continue to perform at their expected levels. These stocks also generally don't pay dividends as they are focused on growth, and you have to rely on investors further driving the price of these stocks higher by buying them at increasingly higher prices to see a return. Now, this is not to say that buying these stocks and growth investing is a bad thing, as I will explain in my next episode. I personally just don't have the risk tolerance for it, and I would urge caution when drawn to these investments. There is certainly something to be said for high-growth companies that pay a dividend. Take, for instance, Apple or Microsoft, Visa or Target, all companies that have historically had and are currently on track for massive growth. They pay dividends. Now, these dividends are fairly low, and you certainly wouldn't buy them for their dividend, but it is quite nice to see these big, high-growth companies paying dividends. This often attracts investors such as myself who want those high growth options but also still prioritize tangible returns in the form of cash and not just stock price appreciation. I hope hope this illustrates my reason for investing the way I do, as I see dividend growth investing as the most stable way to build wealth over the long term, as it has been proven time and again over decades to be a successful strategy. As always, I am no expert. I just want to give my thoughts on investing and take you along for the journey in hopes that you might learn something too, or at the very least, learn from my mistakes. If you want to join me on this journey, consider subscribing and liking this video, and I hope to see all of you in the next episode of Dollars and Cents.